Imagine an entire nation throwing a party, a decade-long festival of youth, jazz, and boundless optimism. Welcome to the Roaring Twenties. After the darkness of the Great War, America was ready to live and to get rich. The future wasn't just bright, it was electric. This wasn't just a feeling, it was a reality you could see on the streets. Cars, once a luxury for the rich, were now rolling off Henry Ford's assembly lines, owned by ordinary families. Radios crackled in every living room, bringing the world closer. Skyscrapers, symbols of this new power, clawed at the clouds above New York. And at the heart of this frenzy was a new religion, the stock market. For the first time, Wall Street wasn't a private club for bankers in top hats. It was the people's game. The message, blasted from every newspaper, was simple and intoxicating. In this new era of permanent prosperity, anyone could buy a piece of the American dream. And, just as Parisians once crowded the Rue Quincampoix for a piece of John Law's dream, or the British gambled their savings on railway lines that would never exist, the average American, from the shoeshine boy to the industrial tycoon, came to believe that Wall Street was a one-way ticket to wealth. So, how did this belief turn into the biggest financial bubble in history? The answer lies in a single, powerful financial innovation: buying on margin. The concept was dangerously simple. To buy a stock, you didn't need to pay its full price. You could put down a small deposit, say 10%, and a broker would lend you the other 90%. It was financial dynamite. If a $100 stock went up to $110, you hadn't made $10 on your $100 investment. You had made $10 on your tiny $10 deposit. You had doubled your money. It was the same intoxicating logic that drove the tulip mania, betting on the future with money you didn't have. But now, supercharged by the engine of Wall Street, this easy credit fueled a relentless upward spiral. As stock prices rose, people used their paper profits as collateral to borrow even more money, to buy even more stocks, pushing prices higher still. The machine seemed unstoppable. It was a perfect feedback loop, built on confidence and debt. By 1928, the market wasn't just rising, it was rocketing. It had detached from any economic reality, like a hot air balloon whose rope has been cut. It was no longer about a company's profits or its innovations. It was about pure speculation. The customer rooms of brokerage houses became the new temples of wealth. Crowds of ordinary people, from clerks to housewives, would stand for hours, mesmerized by the clattering ticker tape, spitting out an endless stream of rising numbers on a giant blackboard. The feeling was electric, a shared belief that they had all discovered the secret to effortless riches. It was a national obsession. Conversations at dinner parties revolved around one question: what's your stock? The shoeshine boy would offer you a tip on RCA along with your shine. The logic was the same that had gripped Britain during the railway mania a century before. A revolutionary technology, mass production, electricity, the automobile, seemed to guarantee infinite growth. People weren't talking about a bubble, but a permanently high plateau of prosperity. The warning signs were there. A few economists, like Roger Babson, warned that sooner or later a crash is coming, but they were dismissed as party poopers. Why listen to reason when your neighbor was getting rich? The market was dominated by the greater fool theory, the belief that no matter how high the price you paid, there was always a greater fool ready to buy it from you for more. The music was playing loud and fast, and in this national ballroom, everyone kept on dancing. And then, it happened. In late October 1929, the music stopped. The confidence that had taken years to build evaporated in an instant. It began on Thursday, October 24th, Black Thursday. A wave of selling hit the market, but this was different. For every seller, there were no buyers. The machine had jammed. The downward spiral was even more vicious than the rise. The margin call was the executioner's blade. Brokers sent frantic telegrams demanding investors pay back their loans immediately. But how? The money was gone, invested in stocks that were now worthless. To cover the loan on one stock, they had to sell another, which pushed prices down further, triggering more margin calls. It was a chain reaction of pure, automated terror. The trading floor of the NYSE, once a temple of optimism, became a pit of despair. Men shouted, wept, and stared in disbelief as their life's work vanished on the ticker tape. Tuesday, October 29th. Black Tuesday. The day the dam truly broke. 16 million shares were sold, a record that would stand for decades. Billions of dollars. Gone. The great American dream had become a nightmare. The crash wasn't just a financial event, it was a cultural one. The party was over, and the bill had arrived. And it wasn't just Wall Street that paid. The shockwave hit every main street in America, and then the world. Banks, which had gambled with their depositors' money, failed by the thousands, wiping out the life savings of ordinary people. This was the spark that lit the Great Depression, a decade of unimaginable poverty. Families lost their homes, building shanty towns they bitterly nicknamed Hoovervilles. A generation was scarred, learning hard lessons about thrift, debt, and the fragility of dreams. So, was this a giant scam? Unlike a Ponzi scheme, the crash wasn't orchestrated by one master criminal. There was no Victor Lustig selling the Eiffel Tower. The tragedy of 1929 is that the illusion was collective. The lies they bought were the ones they told themselves. So what are the lessons? Lesson 1. The most dangerous words in finance are, "This time, it's different." The technology, whether it's railroads, radios, or the internet, might be revolutionary, but that doesn't mean its stock price can defy the laws of financial gravity forever. Lesson 2. Leverage, buying on margin, is a double-edged sword. It rocket fuels your gains on the way up, but it guarantees total annihilation on the way down. And lesson 3. Humans are not rational. We are creatures of greed, fear, and herd behavior. The cycle of boom and bust is not just a line on a chart, it is the rhythm of human psychology. The party of the Roaring Twenties is long over, but the music, in new forms, always starts again. If you enjoyed this dive into the great financial storms of history, subscribe so you don't miss the next episode. And you, what great historical crisis would you like us to explore? Let us know in the comments.